Most people with pensions walk into retirement feeling ahead of the game. And they are. Until they aren't. There are 4 traps buried inside the pension setup that almost nobody talks about. And by the time most people find them, the window to fix them is already closing. That's what this channel is for. If this kind of breakdown is useful to you, hit like and subscribe. It helps other pension holders find this before it's too late. And if you know someone 5 years out from retirement with a pension, send this to them now. Let's get into it. You are in rare company. About 85% of the workforce heads into retirement with a 401k they hope is big enough, and a Social Security check they hope doesn't get cut. That's the whole plan for most people. You have a third leg, a guaranteed monthly check that shows up no matter what the market does. Most workers would trade years of their career to be in your position. So why does something feel off? Because having more pieces on the board means more ways for the plan to break. And almost every retirement video, every piece of advice flooding your feed right now, was built for that other 85%. It assumes your only job is to grow a pile of money and spend it down slowly. It doesn't account for what happens when a pension enters the picture. The pension doesn't make retirement simpler. It makes it different. And different requires a different playbook. There are 4 specific traps buried inside this setup. The first one is hiding in an HR folder that's about to land on your desk. The second one quietly erodes your buying power every single year without sending you a notice. The third turns your own careful savings into a Medicare surcharge. And the fourth one waits until the hardest moment of your life to detonate. I'm going to show you exactly how each one works and what to do about it. I'm glad you're here at Mr.Greenvestor. Let's get into it. Picture this. You're a few years out from retirement. Things are finally starting to feel real. And then someone from HR stops by and slides a folder across your desk. 30 pages, small print, legal language, and somewhere near the front, 2 numbers that are supposed to represent the same thing. Option A, $500,000 deposited into your account today. Done. Option B, $3,500 a month every month for the rest of your life. You have 30 days to decide. Most people stare at that $500,000 and feel something. It looks like a reward, like the company finally acknowledging what 25 years of showing up actually meant. And that feeling is exactly what the math is designed to produce, because that offer wasn't built for you. It was built by actuaries whose job is to calculate what your life expectancy is worth and then price the lump sum just low enough that it saves the company money. They're not doing you a favor. They're transferring risk, longevity risk, market risk, off their balance sheet and onto yours. The number doing most of the heavy lifting is buried toward the back of that packet, the discount rate. When interest rates are high, companies use a higher discount rate to justify a lower lump sum. Most people never ask for it, and the 30 days run out before they realize it matters. Ask HR directly. They're required to give it to you. Now let's run the actual numbers. At $3,500 a month, you break even against that $500,000 in about 12 years. Every single month after year 12 is money the lump sum can never recover. If you make it to 85, the monthly track pays out over $840,000. The lump sum is still sitting at $500,000, minus whatever the market did to it along the way. The lump sum isn't automatically the wrong call. If your family health history is short, if you have the discipline to invest it and leave it alone, if leaving an asset behind matters more than lifetime income, the math can shift. You're not choosing between good and bad. You're choosing what kind of risk you'd rather carry. But for couples, there's another layer most people miss entirely. The monthly pension payout usually includes a survivor election option, a way to protect your spouse's income if you go first. The lump sum eliminates that protection completely. You take the money, you take on both the investment risk and the longevity risk for both of you, on your own. So you keep the monthly check. Smart move. But here's what nobody tells you about that guaranteed income over time. For the first year or two of retirement, everything feels right. The check shows up exactly when it's supposed to. The amount matches what you planned for. You're not refreshing your brokerage account every morning, not watching the market swing. There's a real exhale that happens after decades of building toward this moment. That exhale is earned. Enjoy it. Just don't let it last too long. The problem with a pension isn't the pension. It's the assumption that a number that feels sufficient today will still feel sufficient in 15 years. Your pension is fixed. Your expenses are not. Most plans that include a cost of living adjustment cap it around 2% annually. That sounds reasonable until you look at what healthcare actually costs as you age. Prescriptions, specialist visits, procedures that weren't on your radar at 62 become a real line item by 75. Medical inflation has consistently run above that 2% cap for years, and your actual spending doesn't care about caps. Run the math on a $50,000 annual pension with no COLA adjustment. After 20 years, that same deposit buys roughly half of what it bought when you first retired. The number on the check doesn't change. What it can actually pay for shrinks quietly every single year without anyone sending you a warning. The early years of retirement tend to be the most active and the most expensive in a good way. Travel, family, experiences you've been deferring for decades. You're spending, but you're also healthy. The harder stretch is the one starting around 80, when healthcare costs climb, when you might need help at home, and when the fixed check that felt generous at 65 starts to feel tight. That's the gap most people don't see until they're already inside it. So what actually covers that gap? Your 401k. But here's the reframe most pension holders never make. Once you have a pension, your 401k doesn't need to act like a safety net. Your pension is already doing the job a bond allocation would normally do in a portfolio. It's stable, it's guaranteed. It shows up every month regardless of what the market does. That's exactly what fixed income is supposed to provide, which means your 401k is free to do something your pension never will: grow faster than inflation. That's the shift. One account protects you. The other one grows for you. They're doing different jobs, and treating them the same way wastes one of them. Couples tend to fall into this trap together. One pension comes in, the other is a few years behind, and the 401k quietly gets treated as a backup cushion. Too important to touch, too conservatively invested to matter. That leaves the one asset capable of fighting inflation parked on the sideline, while the fixed income floor slowly loses ground. So now you've got a floor and an inflation engine working together. But the moment RMDs kick in, that engine starts generating a tax bill you never planned for. Here's where the math gets genuinely unfair. Not because the rules are complicated, but because they specifically punish the people who did everything right. Think about where you are at 73, pension coming in every month, Social Security running, the 401k sitting there, largely untouched, because you didn't need it. You saved carefully, maxed contributions for decades, and now that account has grown into something substantial. By every measure, that's a success story. Then the IRS sends you a letter, not a choice, a requirement. Starting at 73, the government forces you to withdraw a set amount from your pre-tax retirement accounts every year, whether you need the money or not. The formula uses your account balance and your life expectancy. The bigger the account, the bigger the forced withdrawal. For most people, that's a minor inconvenience. For pension holders, it's a compounding problem. Your pension and Social Security already put you at a solid income number before you touch the 401k at all. A couple with a $60,000 pension and $40,000 in combined Social Security is sitting at $100,000 in gross income before a single dollar of retirement savings gets pulled. Then a $30,000 RMD lands on top of that. Now you're at $130,000. And you didn't make a single financial decision to get there. It just happened, automatically, on schedule. That number matters because of a surcharge called IRMAA, the Income-Related Monthly Adjustment Amount. In 2026, once your modified adjusted gross income crosses $109,000 as a single filer or $218,000 as a married couple, Medicare adds a surcharge on top of your standard Part B premium. That standard premium is $202.90 per month. The surcharge starts at $81.20 per person and climbs to $487 per person at higher income levels. For a couple sitting in the first IRMAA bracket, that's over $1,900 in extra Medicare costs per year, on top of premiums they were already paying. What makes this particularly hard to absorb is the 2-year look-back. Medicare doesn't use your current tax return. It uses the return from 2 years prior. So the RMD that pushed you over the line in 2024 shows up as a higher Medicare bill in 2026. By the time you see the impact, the decision that caused it is already locked in. The people hurt worst by this aren't the ones who overspent or took shortcuts. They're the careful savers, the ones who maxed contributions every year, who felt proud of the balance they'd built, who assumed a larger 401k just meant more security. Nobody told them that a large pre-tax account sitting next to a pension income floor could eventually turn their own savings into a recurring tax liability. There is a way out, but the window closes. The gap between when you retire and when RMDs begin is often your lowest income stretch in decades. No paycheck. Pension possibly not yet started. Social Security still delayed. That window is where Roth conversions do their most valuable work. Convert pre-tax 401k dollars into Roth at a lower rate now, and those dollars stop generating RMDs, stop triggering IRMAA, and stop being a problem entirely. That surcharge problem gets worse when the household goes from 2 people to 1, and almost no retirement plan models what actually happens on that day. Most retirement plans are built as a couple. You run the numbers together, stress test the budget together, and when everything lines up, there's a real sense of relief. The pension covers the basics. Social Security fills the gap. The 401k sits in reserve. It works. On paper, for 2 people. What most plans don't model is the day it stops being a 2-person household. When one spouse passes, the smaller of the 2 Social Security checks disappears. Not reduced, gone. The household drops from 2 guaranteed income streams to 1, almost overnight. That alone is painful. But what compounds it is a tax filing change that hits at the worst possible moment. As a married couple filing jointly in 2026, your standard deduction is $32,200. The moment one spouse dies, the surviving partner files as single. That deduction drops to $16,100. Tax brackets compress. The same income that fit comfortably inside a joint return now gets taxed harder inside a single return. Not because anything changed about the money, but because the filing status changed. IRMAA follows the same cliff. The $218,000 joint threshold that kept you out of the surcharge brackets drops to $109,000 for a single filer. The pension didn't shrink. The RMDs didn't stop, but now they're landing inside half the tax shelter, and the Medicare surcharge kicks in at half the previous threshold. A surviving spouse can go from no IRMAA exposure to significant IRMAA exposure without a single dollar of new income entering the picture. Fixed costs don't adjust for any of this. Property taxes stay the same. Homeowners insurance stays the same. Utilities, maintenance, the car payment, none of it recalculates because the household shrank by 1. The income dropped, the tax bill went up, the expenses held firm. Two moves protect against this. First, the survivor election on the pension itself. Choosing a joint and survivor payout reduces your monthly amount, but it keeps income flowing to the second person regardless of who goes first. Most couples skip this conversation because the reduction feels like a penalty. It isn't. It's insurance with a guaranteed payout. Second, Roth conversions during the pre-RMD window we covered, done with the surviving spouse's single filer thresholds in mind, can keep that person out of the IRMAA brackets even after the joint shelter disappears. The families who land in a resilient spot didn't have larger accounts or higher incomes. They started making these adjustments 4 to 6 years before retirement, while the levers were still available to pull. None of these 4 traps are inevitable. Every one of them is predictable, which means every one of them has a solution. But the solutions require lead time. 3 moves matter most. Ask HR for the discount rate before you sign anything on the lump sum. Reframe your 401k as an inflation engine, not a backup cushion. Your pension already covers the stable floor. And start Roth conversions now, calibrated to keep your Maggie below $218,000 married or $109,000 single, so you're not handing RMDs the keys to your Medicare premium. If this breakdown helped clarify your picture, subscribe to Mr.Greenvestor and drop your specific situation in the comments. The next video covers Roth conversion timing for pension holders, when to start, how much to convert, and the mistakes that cost people the most. Your pension is one of the strongest foundations you can bring into retirement, but a foundation isn't a full plan. The moves we covered today, the discount rate question, the inflation engine reframe, the Roth conversion window, the survivor stress test, these are the difference between a plan that holds and one that quietly cracks under pressure. Timing is the one variable still in your control. Use it. If this gave you something useful, hit like and subscribe so you don't miss the next one. It also helps other pension holders find this before the window closes. Drop your biggest pension question in the comments below, share this with someone who needs it, and I'll see you in the next one.